Hello and welcome to the Daily Trader. I'm Alex Coffey in for Kevin Hanks. Today is February 28th, final day of the month, and it is a Friday. Lots of things going on in financial markets. Of course, some weakness in equity markets here in the U.S. In recent trading sessions. Got me wondering, is it time to look at some of these market generals that have largely been the contributing factor to the overall market's weakness? A couple names that came to mind were Nvidia and Tesla. Of course, Nvidia had earnings this week. It was not enough to excite investors as the stock ultimately fell post those results. I wanted to look at these two names in particular for those who are maybe looking for opportunities to get into them using option strategies to participate perhaps in what could be a bounce back if these companies ultimately stabilize in stock price and do make a turnaround. Let's start with Nvidia. Of course, was a market mover on the week with its earnings release. It's down about 10% year to date, and this is after being up 40 or so percent over the last 12 months. And we all know the story that Nvidia has been over the last few years in this AI build out. What I looked at, though, was a strategy for the investor who's maybe interested at some point becoming a shareholder in this stock if it were to move lower, but also not necessarily sure that today or right here is the price to buy. Maybe sees more downside in the future, but maybe doesn't quite know where that will be and ultimately when things will turn, because we never do. And so I looked at a 1-by-2 put ratio spread. Now, both of the trades we'll look at, both in Tesla and Nvidia, are only going to go out to the March 14th expiration. So it's only a couple weeks away from today, halfway through March. And what I looked at in particular here was a strategy that will do best if this stock moves right to its year-to-date lows around 113. And so what we did in particular, March 14th, we buy one of the 117 puts, and then looking at selling two of the 113 puts. So for this strategy, you'll see the risk number, the total max loss is actually 10,750. So that's how much money is going to have to be set aside, as there is a short put involved in this strategy that would be uncovered within it. And so if you're looking at that, you would only, perhaps look at this strategy if you were interested in assuming the risk of 100 shares at that break-even point. And so that break-even point with this, if it's done for a $1.50 credit, is 107.50. So perhaps an opportunity to get long this stock if it moves lower at a price that's a good $5-6 below the current year-to-date lows. And again, one of those market generals that's been under a little bit of pressure. How this particular strategy performs, though, really depends on where the stock goes. If it goes right to the sweet spot of 113 and hangs out there, this can be upwards of profitable, of a max profit upwards of $550, as you have a $4 wide debit spread in this strategy. That would work towards $4. But then that extra put unit that you're short would work towards $0, so you'd be working towards keeping that full credit. And so add $4 to $1.50, you get $5.50, and that's how that max profit is found. Of course, the risk, same as the risk as if you were just long shares at a 107.50 break even. So you get that full $10,750. Now, if it just stays out of the money, above 117 as it is now, you would simply keep that credit and those options would be expected to expire worthless. So $150 would be the max profit. So a high probability of success, but an outsized risk if there is a substantial correction on top of what's already happened in Nvidia to the downside, as you would potentially be either assuming the risk of a shareholder or ultimately perhaps even becoming a shareholder if those options were assigned through the expiration date. Moving on to Tesla. Now, this is a stock that's down a lot more than Nvidia has been. It's down around 30% year to date. But again, another name that's had a nice move over the last year or so is it's up, again, around 40%, 50%, depending on where you're looking at the time frame. And so in the case of Tesla, I looked at, again, this is a name. A lot of excitement around the election timeframe, early November. It rallied up, but it rallied from around 265, 270 to ultimately where it got just shy of 500 before turning around. And so we're kind of full circle now. We're getting back into those levels that we had saw just before the election. And so say maybe you think that that breakout point could act as a firm level of support if it does get down there. I looked at a strategy, again, going to March 14th, neutral to bullish, fading the recent move here, looking for a chance to add bullish exposure in a risk-defined way right at that support level around 265. March 14th, 265, 260 short put vertical, looking for around $1.40 credit. Probably would be comfortable, maybe down to $1.25, which would be a quarter the width of the strikes. But at $1.40 credit, looking at a max profit of 140, a break-even point of 263.60, and then if it did continue to slide and fall below 260, you'd have $360 in risk. Now, these are both strategies that expire in a couple weeks, neutral to bullish, and looking to increase bullish exposure in names that had been market leaders but now have turned a little bit more negative in 2025. And really, a large part of the reason why you've seen some weakness in the overall market in recent sessions. Thanks, as always, for tuning into the Daily Trader, and we'll see you next week.